Okay, hello everyone. Thank you so much for coming. My name is Paula Blazquez. I lead the strategic investment divisions at InnoCells. InnoCells is the corporate venture fund of Banco Sabadell. But today we're here to explain a little bit more about how to get a term sheet ready. So just to kick off, by a show of hands, how many of you are thinking about starting your own startup or already have it constituted but are thinking about raising funds? So how many of you are entrepreneurs? Okay, that's great. So you came to the right workshop, I hope. So today, what we're going to do is a little bit different. I'm not going to stand here for an hour and tell you how you're supposed to do your term sheet or your shareholders agreement. What we're going to do with the help of Roca Junyent lawyers, which are here, is that I'm just going to give you a brief intro of about 15 to 20 minutes of the basic terms, and then we're going to try, because the area is a bit small, but we'll make it, to make circles or groups or round tables, about 4 or 5 of them. I've printed examples of term sheets in English and in Spanish. We'll hand them over and we'll answer your specific questions. So here today with me are my team, the investment team at Banco Sabadell's Corporate Venture Fund, which I don't know where they are, but they're somewhere around. They'll sit with you in the tables together with myself, and then Roca Junyent teams which will be answering specific legal questions. So before I kick off and I tell you a little bit more about InnoCells and term sheet and everything, I wanted to have Carlos come on to stage and explain a little bit more about Roca. Can you come in?
Thank you, Paula. Thank you, everyone. Hi, everyone. As Paula said, we are from Roca Junyent. Roca Junyent is one of the leading Spanish business law firm. We are 150 lawyers in Spain with principal offices in Madrid and Barcelona. So we cover the 2 main hubs now in Spain, the Barcelona hub, where maybe there are more startups, more entrepreneurs, and probably the financial hub for startups in Spain, which is Madrid. I mean, the Spanish ecosystem is very integrated, so we are continuously seeing Madrid VCs investing in Barcelona startups, or Barcelona VCs investing in Madrid startups, or startups from other cities in the country. No, we as a firm are part of TerraLex, which is probably the most important network of law firms. We have presence in more than 100 countries, and I would say that the main difference between Roca Junyent and other big law firms in Spain is that we really believe in the importance of startups and entrepreneurship. From the very beginning, when many big law firms thought that this was not profitable, this was not for them, we should only work for big banks and big corporates, we were very sure and convinced that the economy only can go ahead through innovation. And if you see now the top companies in the US or in the world are companies created not much more than a decade ago. So if you don't invest in startups, you won't be working with the top companies in the future. No, we are used to work with startups, but also with VCs. We understand both sides of the table. So I think this is a good advantage, because you as entrepreneurs, I think most of you, as you said, are entrepreneurs. It's good to understand the mind of the VC. What can they be thinking, or what is market practice? I mean, we in the VC practice, the startup ecosystem, it's mainly imported from the US, from California and New York, but we need to adjust it to a specific jurisdiction. And so market practice is fundamental. And having advice in several transactions, in many transactions from one side or the other side, I think can be very, very helpful. No? And I don't know, I'm not going to list all our clients in the sector, but I mean we work with some top VCs in Spain, like Innocels, other vehicles from Banco Sabadell, or we work also with Fit Talent, Everest investment arm. We work with top startups like Amovens, which is one of car sharing leading company in Spain, Tico, which is our top PropTech, or some other very recognized Spanish startups. No, I don't want to waste more time just talking how best we are. I think the thing now is that we can tell you the main tips about term sheet and how do you have to approach the term sheet stage, which is crucial. As Paula was explained, a term sheet is apparently non-binding, but it's very important for the next stages of the transaction. So I think negotiating a good term sheet is key for a successful transaction.
Great, thank you so much, Carlos. Okay, so let's kick it off. I'm a little bit of a sore throat. I don't know if everyone from behind can hear me. I can try and shout a bit more. So if you don't hear me, just go like this on the back, and I'll try to shout a bit louder. And I'll drink a lot of water in between. Okay, so really quick on InnoCells, just for the ones that don't know us. We're a corporate venture fund of Banco Sabadell, which is the fourth largest bank here in Spain. We have operations in Spain, in Mexico, and in the UK, where we acquired TSB Bank a couple of years back. We invest in B2B and B2C, but of course we have a natural bias towards B2B. Why? Because we're in a strategic fund, so therefore we always try to partner with the startups where we invest. And obviously it's easier to partner with B2B startups or B2B2C rather than it is only on B2C. We invest in seed, Series A or Series B, or ticket sizes range between 500K up to 3 million. We've done some digital M&A as well. During 2018, we acquired 2 companies, one in the payment space and the other one in the online lending space. And we've also done some fun investments, one in Silicon Valley, one in Israel. Why do I tell you this? Just if afterwards you want to talk about any of these geographies, we're happy to discuss about them. Our geographies focus, we're geography agnostic, but we have a natural bias towards the geographies where the bank is based, of course, or any geography that's basically a tech hub. So that, again, Israel. We've recently invested in Singapore in a conversational banking startup called Active AI, or the US, especially in Silicon Valley. And basically areas of strategic focus: fintech, proptech, wealth tech, regtech, cybersecurity. So anything fintech related, but in the broader sense of the word. So anything that can basically help the bank fast forward innovation internally. And that's about everything I'm going to tell you about me. So now let's really kick it off with the term sheet. So a little bit on getting ready to preparing your term sheet, and a little bit on steps that you need to. You're not seeing the screen, right? Yeah. Let's see. Okay. A couple of things that you need to prepare beforehand you meet with a VC. So bear in mind that VCs always invest in lines and not in dots. What I mean by this is make sure that you keep in contact with them, you keep an updated deck, you keep an updated business plan, and you follow up with them with emails, giving them your traction, etc. Because you don't expect to go to a VC just right about when you're running out of cash and have them make an investment decision, because usually these things have a governance in place, and it takes a little bit of time. Always be due diligence ready. So again, just as I mentioned, open up a OneDrive or any sort of exchange, kind of online exchange portal that allows you to exchange files and upload those all the time. Upload your metrics, your business plan, your historics, how your cohorts have been evolving, anything that you can put up there. So whenever a VC comes and asks, okay, can you give me your most updated deck or pitch or business plan, whatever, you have it ready for them. Also define parameters and expectations. So a question you need to ask yourself before raising capital is, how much do I want to raise and what do I want to use it for? And the reason, and we're going to talk about it afterwards, but you need to be clear on how much you need for the next 12 months, more or less, which is more or less a typical amount of time that happens between a round and round, although it varies depending on the geography. And what is going to be the use of funds, and depending on the amount you're going to raise, by a typical kind of rule of 15 or 20% dilution, you more or less get the valuation you should be looking at. But we're going to talk about this later. And also finally define what you want and what you expect from your investors. Look at your investors from a top list down to the bottom, and think of, you know, what type of investor do I want in my cap table? Do you want a strategic, a B2B? Do I want to partner with them? Do I want an investor that has prior experience in a startup such as mine, which is probably something you like? Do you want an investor that opens up doors in a geography where I want to go next in the next couple of 12 months? So bear in mind all those questions and put them all together. It's not only a question of cash, but also opening doors, networking, etc. So they can give you much more than cash, and have that in mind. A couple of red flags when raising capital and preparing your term sheet or shareholders agreement. Giving up too much too soon. Always aim for the 20-30% dilution rule. So a thing that investors don't like once you advance over your kind of fundraising rounds is when the founders get too diluted and they basically lose control of the startup. So at the beginning of your early stage years, you want to founded control the startup. So, you know, they're very mind that kind of balance, and always try to not get too diluted in the way that you can. Also, we are looking a lot for team commitment. So red flags that we look is people working part-time or people working in different projects, not too committed. One thing that we expect to have in these cap tables is option pools. We'll talk about them later as well. We like to have employees kind of committed to the startup, so we are okay with allowing for some dilution for ourselves. For key employees, being able to gather that equity for themselves on the project and being engaged and aligned in the future. Numbers matter, so of course don't misrepresent any numbers. Something that a lot of culturally it really varies. So this is something Americans don't typically do, but usually Mediterranean countries we do a lot. We all kind of overestimate what we've done, and this is pretty easy when you're talking about, you know, how you calculate your active users. You know, if you say, okay, if they log in once every 6 months as an active user, well, probably it's not. If you inflate those numbers and then a VC realizes that, it's very hard to win their trust back again. Probably you're never going to win it back again. So then reputation is key. And finally, NDAs, Carlos mentioned it as well. So these are, usually term sheets are non-binding. VCs are not out there to steal ideas, typically, and it's very, very rare. They are not. You just feel free to have a conversation that it's with them and discuss about the terms of your startups, your metrics. They're not there to steal your ideas. Don't go around asking for NDAs too quick, because it's something that's a bit annoying. We usually have to pass it on to our legal department, which we do. I mean, if you ask us for an NDA, we will do it. But it's just, you know, typically it's something that at term sheet level you wouldn't ask for. So now, ins and out of a term sheet. Basically, when looking at a term sheet, you have two types of provisions. The economic provisions and the control provisions. So as far as economic provisions go, valuation or price would be, of course, one of the most important things you have to figure out. This, of course, depends on the stage of your startup, the geography you're looking at, the use of funds, how much you want to raise. But as I mentioned before, expect or aim for the 20-30% dilution rule per round. So I've actually, just to be clear on that slide, in italics you have what would be kind of typical in the market or standard in the market. So for you to have an idea, in terms of founders and employee vesting, so this is basically clauses so that instead of the founders getting all of their equity in advance, they'll be getting in as the project advances. This is something that VCs would typically look for. because it means that the founder is aligned with the project in the long term. So we look for 4-year vesting, 1-year cliff. 1-year cliff means you wouldn't be getting any or part of your shares at the beginning when you start the project, but you'll be getting it on a 25% basis over the next 4 years. So you might say, okay, this is my startup, it's my company, why should I do this? Well, the reason is we invest in the long term. Our horizons are 10 years, so we want to make sure that the founder where we invest, because we invest in people and not in projects, is going to be there at least for the next 5. So the type of security, here you have different options. You have preferred versus common. You can put in a liquidation preference. What is very standard, I would say, is the non-participating preferred shares. This would be the shares you would give a VC, and basically it means that they can either decide whether they get their in the event of a funding round, they get their money back, the money they put in, or they convert to common shares, and they'll get their pro rata on the valuation that is established for that round. So this is typically done just to make sure that the VCs put it in, just to make sure that in the event that either a down round happens or the company doesn't go as well as planned, and for any reason there is a liquidity event, an acquisition of the company or an acquisition of a part of shares, they will at least get the money they put in back. So before any type of common shareholders. I don't know if you have any questions, just raise your hand. And liquidation preference, basically, so this is non-participating preferred liquidation. If you see term sheets with, like, a VC asking for a 2 times liquidation preference, this is typically not a standard anymore. This was done before. You wouldn't usually see it. It's basically that a VC is asking to get twice their money back before they get into their pro rata. So it's a little bit of a stretch out for a VC. So you shouldn't be aiming for this type of clauses in which are a bit too strong. And then finally, an option pool. As I mentioned, we're happy on giving employees a part of a part of the results, let's say, of the company. So the average we would be seeing, depending on the company, is between 10-15%. It's not that we love to get diluted by a 10-15% basis, but we understand why they do it. And at the end of the day, again, we invest in people, so we want to make sure that we have the best people in place to develop the project. And if we need to give them equity, then it shall be. For the control provisions, which are probably more legal terms, but you actually have to be very careful about. So again, in terms of board of directors, early on a founder should be or should have a founder control board. So when you constitute your clauses for deciding what type of matters the board is going to decide on and how much of a percentage should be acquired or accepted to decide on a matter, look for percentages that give you kind of the control over the startup. There will be some reserve matters which are very key things, but very few, where probably the VCs would look for having control about, which is usually where your headquarters or the activity of your company that it doesn't change. So things are very kind of obvious that they have also the control or at least a say about it. So again, these would be along the lines of the protective provisions that I just mentioned. Then finally, what you will see a lot is information rights. So VCs will always ask to have on a periodical basis a type of a report or information on the development of your company. And this would probably be included in the term sheet and in the shareholders agreement. And finally, other clauses you should take into consideration, which we usually see. Drag and tag, you'll always fund them. Drag is just to protect the majority shareholder. So in the event of an acquisition of the company or majority portion of the shares, the majority shareholder can actually drag the minority shareholders into selling. And this is just to protect the idea of that in the event of a sale, which would be, in our case, the way we would get a financial return, we're able to actually get it. And then tag is the other way around, to protect minority stakeholders, so that in the event, again, of a liquidation, they are able to tag along to the majority shareholder and share their shares, so that they're not kind of stuck in the startup once the majority shareholder has gone or the founder has gone. Then right of first refusal, this is non-typical. So be kind of very careful with this one. Basically, what it means is that, again, in an event of an acquisition, whoever owns this right is able to make a counter offer. So if an acquirer comes to you and gives you a 5 million offer, let's say, they are able to just basically equal it or give the same amount and take the company. This shouldn't be a problem theoretically, but the truth is that in the market, this is not well seen, because then what it would mean is that a potential acquirer that is interested in your company will be doing all the due diligence, will be establishing a price for the company, and right by the time they made the proposal, then someone that has this clause basically just it doesn't even need to top it out. Just say, okay, I'll keep it for that amount. So basically deters potential acquirers for coming in and making an offer. So be careful about this one. And then something that is very typical is the pro-rate rights or preemption, so which is basically VCs would always ask to be able to participate in the long term in your startup, which means that they will ask to keep their stake they currently have in your startup in the next financing round before any other VC comes in. So let's say they have a 5%, so at least they'll ask that in the next financing round they want to maintain their 5% because they're there for the long run. Usually 5% is a very key number, because at least in Spain, tax-wise, you get like tax exemption if you have over 5% of a startup. So this is one of the reasons why you will see a 5% rule along a lot of VCs, at least here in Spain. So this has been about just a bit of an overview on all the clauses. We'll look at other considerations now, but don't worry. I know I've skimmed through a lot of them. Because what we'll do now is do the roundtables, and you can ask specific questions and dwell into the whole idea around that. So other considerations that you have to take into place is so as I mentioned before, we go through our governance. We have some prerequisites for approval. So always be in touch with your VCs and bear in mind that they have an an investment committee that approves their investments. So they need some time to do their due diligence and actually pass it on to the investor committee, come back with questions, and then decide to make the investment. So some time for that when you decide to raise funds. IP rights, this was just a quick note I wanted to put in. Make sure that if you're an IP protected company or you have IP, it's under the company name and not one employee, because this is a source of huge problems, and it comes up in the due diligence very easily, and it's a huge flag for an investor. So we want to have the IP in the company and not in a specific person. And then finally, as I mentioned, TS are non-binding. A little bit about finding the right partner, but I'll mention this really quick. Just make sure that you have aligned interest on where do you want to go, who do you want to have in your cap table, because this is for the long run, and make sure that whatever the clauses they put in, they're market standard, and you're not accepting clauses that are like very rare in that sense, or very negative. Make sure that they add value, that they're responsive, that they share your strategic vision, that they pick up the phone when you call them, that they help you out to meet people, that they help you out at work or commercially. And always look into their investment history. The same way we do due diligences and we look for not only traction, but also we do reference calls and see, who was your previous employer, or, what is the vision of the team on the founder, or let's call this client and see what they think about the company. Do it the other way around for the VCs as well. Call, if you can, the startups where they've invested. At least look at what type of startups they've invested and how, if there's information in the market. If you can, definitely call other VCs around and ask them about a particular VC, or usually it's easier to go to the startups where they have investors, and they're usually happy to share that information with you. So do your due diligence as well on the funds. Another thing, it's the follow-on signaling. So what I mean by this is typically you want an investor that follows on your next fundraising rounds, and it's there for the long run again. Usually if they don't follow on, it typically means that they're not too committed with their startups. If you see that they're not following on in their startups, it's usually a negative signaling in the market. And basically, I've covered all I wanted to cover in the most boring part, I guess, of the presentation, which is just basically me speaking. The idea now is I'm going to hand out term sheets, standard term sheets in English and in Spanish to all of you that want it. We have also a digital version. You can write to hello@innocels.io to get one. We're happy to share it with you. But we will now, if we can make, the first 2 rounds, second 2 rounds, third 2 rounds, probably circles, and we are now going to discuss these particular terms or your particular questions about your startup, and you'll discuss it with the investment team and the legal team. So you're obviously welcome to stay. I think this is the more productive part of the conversation rather than just me presenting. But thank you so much for listening.